Out of the 9,000 or so stocks in the stock market right now, what is the best stock to buy, in my opinion? I'm going to tell you exactly what stock I think is the best to buy right now, and I'm going to give you a good idea of when to buy it. I think it's time to buy the dip. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm Stephen Fox. Welcome to my channel. I've been pounding the table on super microcomputer, symbol SMCI, for over the last year, longer than that. It's long been a favorite of mine, and it's gone up in price steadily. It has a low price to earnings of about 10. Its earnings growth rate is about 40%. Its current price is about 105 and is valued at about 165. Okay. They recently, on April 24th, they announced that their revenue was going to be somewhat less than they thought it was going to be. And that's because of supply chain problems and getting the various components they needed to make their equipment, especially servers. So we expect them to do well. I think that they were right in cautioning the market that they're going to have somewhat less revenue. Looking at the one-year chart on an SMCI super microcomputer, you can see it has a nice upward course over the last year. Now, it had a recent dip on April 24th because of that announcement that their revenue was not going to be as high as they wanted it to be because of supplier problems. But they've reassured the market that those have been largely fixed, that they're not running into that so much anymore, and they're going to be able to supply the people buying parts from them. So I think this is a chance to buy it at a relative dip. It was above 110 not too long ago. SMCI is above its 50-day moving average, which is good, and its relative strength is 52, indicating that it's neither oversold nor overbought. I think it probably will dip a little bit on Monday and Tuesday, simply because people are anticipating the 0.25 increase in the interest rate. So I think that's what's going to happen. It's probably going to dip down on Monday and Tuesday. Now, what's really interesting is on that Tuesday, they report their earnings. May 2nd, Tuesday, May 2nd, they report earnings. And so if you want to wait until the earnings come out and then see if they are better than expected or worse than expected and how the market reacts to all that, you might want to wait till Wednesday morning or buy it in the aftermarket on Tuesday. I probably will buy it beforehand, simply because I think it's a long-term hold. And also, I find the only way to benefit from these earnings report is if you buy it before. If you do it afterwards, usually everybody knows, and you know the price goes up, and you're kind of left kind of wishing that you had bought it. In any case, if it should go down a little bit, I'm not disappointed. I will buy a moderate amount, and then if the earnings are positive, I will buy even more on Wednesday. Inflation indicators came in about as expected.
What we have seen is not going to influence the Fed for this meeting. It's maybe the next meetings that they're going to start thinking about. When you look at the income and spending numbers, we've seen the same pattern as we had seen in the prior 2 months, strong January, weaker February, and then in March, spending comes in completely flat. Income's up 0.3, same amount, and you can see the savings rate did go up. So people still have some cash but they seem to have pulled back on spending it. Is it because of inflation? Well, headline went down, especially on a year-over-year basis, base effects in that, but the core not moving all that much. However, the, shall we call it the J. Powell indicator, the PCE core X housing did decline again. So we see on a both month-over-month and year-over-year basis that slowing somewhat, which would be good news for the Fed if that continues. The employment cost index, which they like to look at because it's more granular, but it is only quarterly, comes out for the first quarter, and it's pretty consistent. Compensation, wages, and salaries and benefits all up 1.2%, a little bit more than they were in the fourth quarter, but not a huge jump.
And in good news, the Trueflation website, which uses many sources of data and is much more current, reports that inflation is down to 3.96%. Below 4%? Yeah, that's good news. You know, we have signs that a recession is coming, but it looks like it's going to be a mild recession because jobless claims are actually falling and people are actually spending more.
Economic data out about 35 minutes ago. Mike McKee can break that down. Morning, Mike.
Good morning, John. I want to start with jobless claims because that's having an impact on the market. 230,000 after 246,000 the week before. It does suggest the labor market remains tight, and that is going to keep the Fed on alert. And the labor market being tight may have contributed to a stronger consumer spend in the first quarter than anticipated by many people. 3.7%, down from the overall estimate, but it is higher than we saw in the first quarter. GDP overall comes in at 1.1%. Now, people are saying that's weaker than expected, but the Atlanta Fed number that came out late yesterday pushed that number down to about 1.1%. And I wonder how many people would have changed their forecasts had they had the time. Business investment really weak, and the change in inventories is what really moved things in terms of the first quarter. Subtracting $1.6 billion from inventories instead of adding, you can see how much was added in the fourth quarter. And exports, little difference. The data basically say consumer spending is strong, and consumers are hanging in there. Do they continue? Businesses don't seem to think so. Business spending dropped off significantly. Trade, little change, as I mentioned, but the inventories crash sets the Fed up for a question. If the consumer remains strong, do companies start building up inventories again, and then growth goes up, and that pushes on inflation? Or do consumers fall back to meet what business expectations are? Real final sales, 3.4%. That takes out the inventory aspect of it, and that suggests we do see some strength. Now, here's the chart that I promised earlier on surveillance, John. This is the Atlanta Fed GDP now. Never mind the numbers on the chart, although they are pretty close at 1.3%. But look at the trend. We started the quarter, came into the year on a high note, and ever since then, the economy has been slowing down. Does that suggest that that's what we're going to see going into the second quarter and onward?
If any of this has been helpful, please smash the like button. And it looks like we have another bank failure with First Republic. I think the market will overreact to this on Monday and Tuesday, and that's why that's a good time to buy in my mind. So I don't think it's going to have large systemic effects because the Fed has their bank term funding program and their discount window that I think takes care of things. And what's going to happen is that some large bank like JP Morgan, one of those, will buy it. And they will make a lot of money. So it's actually good for the large banks. And the Federal Reserve actually wants fewer banks in the country. It thinks we have too many banks, and that's what makes it difficult for them to supervise all these thousands of banks. And so they actually want less banks. And so I think this is worth another quarter point or maybe a half point increase in the interest rate. And so I think it actually helps prevent the Fed from increasing interest rates more. When they see banks going down like this, they're less motivated to increase the interest rate. So I think the next interest rate increase will be the last one, at least for a while, unless inflation gets worse. And it does not look like it's getting worse. You know, I think we're going to have a soft landing, but it's going to come in a different way than people expect. It's going to come the way it came in the 1980s, where the Fed had to keep raising rates, but the economy was more or less able to handle it, and the stock market went up in the 80s. I made money in the 80s, and I think we're going to make money now. I think now is a time to buy the dip. Looking forward 6 months to a year out, you will make money, I think. Please smash the like button. We'll keep on trying to figure out these crazy markets. This might be a time to buy the dip if you're long-term focused. The short term is, like I said in a previous video, I thought we were going to have a boom, which we've had, and then we were going to have somewhat of a bust, and then it was going to boom again. I'm thinking that the bust is going to be short term, 6 to 9 months. We shall see, though, right? Okay, thank you.